This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 24, 2026, and this is the New York session. Now, let's get into it. Good morning. We are opening into a market defined by extreme caution. The Fear and Greed Index has collapsed to 14 out of 100, signaling a fearful regime that is driving capital squarely into safe haven assets. As we approach the final pre-FOMC session, the dollar is strengthening broadly, pressured by geopolitical shocks in the Middle East and weak Canadian data, while equities retreat into a low-volume grind. Let's look at what is moving the tape right now. Before we dive into the crosses, let's check the schedule. There are no major scheduled data releases for the remainder of this Friday session. However, all eyes are fixed on the horizon. The FOMC rate decision is locked in for Wednesday, July 29th. That single event dominates the next 48 hours, overshadowing everything else. Beyond that, we have the dollar GDP now estimates coming in on Tuesday the 28th and Thursday the 30th, alongside ISM manufacturing and PCE data. But for now, the market is in a holding pattern, waiting for the Fed's hand. The broader picture is stark. Geopolitical risk from explosions reported in Saudi Arabia has triggered immediate safe haven bids in both gold and the US dollar. Simultaneously, Canada's June PPI came in at negative 1.4%, missing expectations of negative 0.4%, providing fresh fuel for dollar strength against the loonie. Meanwhile, the VIX is sitting at 16.64, suppressed despite the extreme fear in the sentiment index, suggesting a latent volatility trap ahead of the weekend. Pulse, Grid, CIPHER, SPECTER, let's dissect the flows. The macro environment is currently locked in a severe policy trap. We have core PCE holding stubbornly at 3.41% against a backdrop of soft GDP growth, 2.9%. This divergence gives the Federal Reserve zero room for dovish pivoting ahead of the July 29th decision. The 10-year Treasury yield is at 4.67%, and with the 2-year at 4.31%, that plus 0.34 percentage point spread is a classic recessionary signal. It forces capital into the dollar not because of U.S. growth, but because of relative yield superiority and absolute safety.
Technically, that macro pressure is compressing price action into tight ranges. Look at euro-dollar. It is currently trading at 1.1383, pinched against the lower bound of its 5-day range, which started at 1.13638. We are essentially touching the floor. On the flip side, dollar-yen is at 163.8, hovering just below its 5-day high of 163.98. The market lacks conviction. There is no explosive breakout, just a slow grind upwards in the dollar, testing resistance and support levels with increasing frequency.
And that grind is built on incredibly fragile foundations. The COT data reveals that leveraged funds are massively short euro at minus 53,691 contracts and short yen at minus 90,461 contracts. This is overcrowding, while DXY leverage funds are net long at plus 4,438. The weekly decline in those longs suggests spot buyers are hesitating. The current dollar strength is being driven by speculative shorts piling on, not necessarily by aggressive new buying in the spot market. If that sentiment shifts, the unwind is going to be violent.
That fragility is exactly what concerns me. You're looking at the shorts, but I'm looking at the VIX. It is at 16.64, well below its 5-day upper bound of 19.5, yet the Fear and Greed Index is at 14. This inverse relationship is dangerous. Volatility is being sold off while actual portfolio stress is maxed out. We saw gold drop 0.46% intraday to 4,028.44, despite the Saudi headlines. That sell the news behavior in the premier safe haven tells me capital is rotating out of gold and back into dollar cash. It's a liquidity crunch mentality, not a rally.
Let's pivot to the specific assets feeling this pressure. First, let's talk about dollar CAD. It is at 1.4077, down 0.6%. The Canadian data shock is fresh in the minds of traders. How are we viewing this pair?
Fundamentally, the PPI miss is the driver. Technically, however, $CAD is showing resilience against the wider risk-off trend. The pair is holding above its immediate structural supports. The movement here isn't a crash, it's a controlled slide. The lack of a spike in volatility suggests the market has already priced in the weak Canadian labor and housing data, including the new housing price index ticking up slightly to negative 0.1% versus the negative 0.3% last month. We are seeing stabilization, not acceleration.
Agreed, the positioning confirms it. Leveraged funds are net short Canadian dollar at minus 92,771 contracts, reflecting deep skepticism toward the loonie after the PPI miss. But notice the asset managers, they remain net short Canadian dollar at minus 106,484. The move is consistent across both speculators and long-term holders. There is no divergence here telling us the sell-off is exhausted. The flow is uniform.
But remember, this is happening in a vacuum of global liquidity. The ECB has reiterated that policymakers are not seeing second-round effects and are stressing data dependence. That keeps the euro relatively weak, which indirectly supports the dollar against everyone, including the Canadian dollar. The US dollar is rising because everywhere else looks uncertain, not just because Canada is weak. The 3.63% Fed funds rate is the anchor keeping this entire ship steady. Moving on to gold. Gold is at 4,028.44, down 0.46%. SPECTER, you flagged this as sell the news. What is the technical structure telling us about this pullback?
It's a warning sign. Gold had spiked earlier in the week, hitting highs near 4,166, and it has now erased those recent gains. The fact that it is dropping nearly 0.5% despite the Saudi explosions means the initial geopolitical bid is fading fast. We are seeing profit-taking at the higher levels. If gold breaks below its current support at 4,023.18 without a corresponding drop in U.S. yields, it signals the end of the safe haven impulse. We aren't seeing a base forming, we are seeing an exit door.
Visually, you're right. The price action is consolidating around the 4,028 level, well below the 4,051 resistance mark from earlier in the week. The 5-day range has expanded significantly from that high, but the current candle is contracting. We are losing momentum. The chart doesn't show a reversal pattern yet, but it certainly doesn't show continuation of the spike. It's a pause, possibly a turn.
The flow data backs the hesitation. While DXY is long, the specific metal holdings in leveraged funds don't show the same aggressive accumulation we saw during the initial spike. The speculative interest in gold seems to be cooling off rapidly as the fear metric hits 14/100. Investors are taking chips off the table rather than chasing the breakout.
Let's look at cable. It is trading at 1.3314, essentially flat. Grid, you mentioned earlier that pound is testing structural lows. Why is the pound failing to rally even as the dollar strengthens moderately?
Because the internal structure is broken. Cable is testing the 5-day low of 1.32989. We've seen a clear downward drift from the 5-day high of 1.34813. The price is pressing against support and every bounce has been weaker than the last. The technical narrative is bearish. We are holding by a thread. If that 1.32989 level goes, we expose lower liquidity zones with no immediate buyers stepping in to defend the midpoint.
Here is the fascinating divergence. Leveraged funds are net long pound at plus 28,541 contracts, having added 29,099 contracts week over week. Smart money is accumulating longs while the price is falling. This is a classic accumulation phase. Institutions are buying into the weakness created by the risk-off environment. They know something the chart doesn't show yet, that the pound might be oversold relative to its medium-term fundamentals.
Accumulation doesn't matter if the trend is down. The UK economy is facing similar stagnation pressures as the US, with the Fed holding at 3.63% and the Bank of England likely to follow suit given the global growth slowdown. There is no yield differential to support a rally. The pound is being dragged down by beta. not alpha, until risk appetite returns, which the 14/100 fear score says it hasn't. Those longs are just catching a falling knife.
Or they are setting up a squeeze. If that 1.32989 support holds, and we see a sudden spike in the VIX from 16.64 back toward 18.5, those leveraged longs could trigger a short squeeze on the shorts who bet against the pound. But right now, the risk is that the support breaks. In a fearful regime, technical support is often treated as a sell zone, not a buy zone. Retail traders are getting stopped out, feeding more selling pressure into those longs.
Finally, let's address the elephant in the room, euro-dollar. It is at 1.1383, up 0.5%, but barely. Grid, you said it's touching the floor. CIPHER, you said the shorts are overcrowded. How do we navigate this pair right now?
We treat it as a trap. The price is at 1.1383 and the 5-day low is 1.13638. That is a distance of less than 20 pips. Any minor selling pressure can breach that support. Conversely, the 5-day high is 1.14496. The range is compressed. We are in a coiled spring. From a technical standpoint, there is no clear direction, only a boundary condition. We are waiting for a break, either down to 1.13 or up to 1.15. Right now, we are stuck in the middle, vulnerable to whipsaw.
And that vulnerability comes from the positioning. Minus 53,691 contracts short euro. That is a massive concentration. If euro-dollar breaks below 1.13638, those shorts will rush to cover, potentially pushing the price up sharply. But if it holds, the shorts will continue to press, knowing the macro headwinds from the ECB are real. The data-dependent language from ECB policymakers reinforces the dollar's edge. There is no catalyst for a sustained euro rally unless US data suddenly collapses.
Correct. The ECB is cautious. The Fed is rigid. The yield differential favors the dollar. The 1.13638 level is not just a random number. It represents the equilibrium where the Eurozone's economic weakness meets the dollar's safe haven premium. Breaking it confirms the dollar's dominance. Holding it keeps the status quo. Given the VIX suppression and the fear score, I expect the status quo to hold until the FOMC forces our hand on Wednesday.
Let's synthesize this. Grid flagged the compression in euro-dollar around 1.13638 and the downward drift in cable toward 1.32989. CIPHER highlighted that despite these technical weaknesses, leveraged funds are aggressively shorting euro and yen while accumulating pound longs. Pulse noted that the macro rigidity at the Fed, with core PCE at 3.41%, prevents any meaningful relief for these currencies. And SPECTER warned that the gold pullback to 4,028.44 suggests safe haven flows are rotating back into cold, hard cash, not commodities. The consensus here is that the dollar is strong, but the market is overly short on its rivals, creating a fragile equilibrium that could snap if the FOMC hints at anything other than a hold.
So, what is the takeaway for the rest of the day? First, the US dollar is commanding premium pricing due to geopolitical risk and sticky US inflation, with dollar CAD and dollar yen leading the charge. Second, the fear and greed index at 14/100, combined with a suppressed VIX at 16.64, suggests latent volatility is building, particularly in gold, which is showing signs of profit-taking. Third, crowded shorts in euro and yen create a risk of violent reversal if risk appetite returns. But until then, the path of least resistance remains sideways to slightly higher for the dollar. Tomorrow, we wait for the FOMC minutes and the GDP Now estimates. Stay disciplined, manage your risk, and watch those support levels. This is the ShadowQuant Forex edition. Remember, this is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.